to you all. So welcome. It's nice to speak to you again after a couple of weeks, and I will hand over to Todd to kick us off. Todd.
Thanks, Tony. I hope everybody is well and recovering and into the next phase of change and reopening of the world, albeit sort of stumbling down the hallway after a long sleep. So I'm going to talk a little bit about awakening and the practical issues that we're getting through and looking at from what we're seeing, and then also looking at how that tails into what your financial structure and your financial planning can be. So any queries or questions throughout that, happy to talk, raise those then, and Tony will keep me on my toes, I'm sure. So basically some of the things that everybody's looking at is new training for premises and usage, and Nick will talk about some of those things that are coming through at a practical basis. There's access to offices are now getting easier. You don't have to have 2 people in a lift, but you're allowed to have a reasonable amount of people, but you're not allowed to touch anybody. So I think the days of the crush into the lift are gone. I'd say probably from what I've seen is that you're looking at, rather than 2, it'll probably be 4 to 6 in a lift, which will mean the hour and a half entry times will probably only be half that. But I think there'll also be some practical issues around how people work around that, i.e. there might be a 4-hour coffee break at the start of the day for everybody who can work downstairs rather than trying to fight their way upstairs. In the home office, it's now replaced the hot desk. There is no way that a hot desk will work unless you have the ability to be able to industrially clean every day. So that's cost prohibitive, I would expect, and it's probably going to end up with an expansion of everybody's individual area. I'm already seeing it in our business where we are looking at cubicles which are too close together, or desks that are too close together in a run. So we will have to only have one of those people in the office at any time. That's going to create some rostering issues and also how we separate some of our teams into 2 teams if we need them to go out on site. So private equity are definitely looking for opportunities. We have something coming up next week, tentatively booked in for the 27th, with an owner of a private equity firm who will be giving you a feel around. We'll put him under the microscope and ask him how he's actually going about things at the moment. What is he looking for? And that'll obviously be open for questions if you have anybody you'd like to talk to that. Private equity in general are looking at opportunities now because they are a way out of this scenario for a lot of those businesses that can't see a funding structure or a investment structure under their current owners that can get them out. But there is a viable business there if they can dig through the next 6 to 12 months. So they're becoming part of the solution we see, and it's a better option rather than debt. In terms of public transport, that's going to be an issue. We're obviously spoken to a couple of clients this week who are looking to acquire or buy into hubs and satellite office structures around the edges of the city, rather than making people come all the way in, whether they can walk or ride or whatever else to certain venues, be that in the eastern suburbs or the inner west, further out west, and then the north, and preferably for me somewhere south of the border, so that people don't have to do the travel and don't have to deal with a lot of these issues, where they can actually just go to a place where they can drive, park, walk into the office, work, and walk out. Because although home offices have obviously been utilised, people are now wanting to have some level of semblance of work day. And that's the next issue that we see coming through is that some people are now starting work days at 6 a.m. and ending later. And there are staggering of those days so that people can get into and out of structures. And that's a flow on, I think, of the closeness and how you actually utilise your facilities. The networking is interesting. People are now getting off the virtual and want to be doing a few different things. And that's some of the feedback that we're having is we're getting invited to stuff, and Nick and I might break bread next week in a closed restaurant or the week after, which will be interesting. getting there and getting away will be interesting, and then how everybody sits, and whether it is like the Knights of the Round Table or whether it transitions back to something over the next few months. And the other thing we're seeing is lots of opportunities to merge, consolidate, and solidify. You've seen today that Wesfarmers have taken the opportunity to finally put Target out of its misery and bring it in, convert it across into being Kmart. And that's, I think you'll see a few more of those things come through as people take this opportunity to action some restructures and finish those things off. So on the next page, so then that leads into the financial aspects. At the moment, because everybody's looking at JobKeeper and also funding structures and beyond, the real thing that we see the necessity for is a 13-week rolling cash flow with base estimates on a conservative basis, and that helps people manage their cash flow now that now that JobKeeper is coming through, and then thinking about where they're going to get to, because obviously the big issue we can see coming is if JobKeeper gets turned off, a lot of those businesses are going to return to a position where they can't continue. And we suggest now is the time to be starting to plan that. The obvious issues, you don't know what revenue is going to be like, but it's just trying to plan your worst case and then work backwards from there. So we're breaking that into 13-week rolling, which gets you into a July, and then looking out to 30 September, and then seeing what the 3 months beyond that into December look like, and then see what you need to do. And I've literally been on a phone call for an hour this morning, and that's what we're working through. There's a little bit more complication with that because there's some personal issues as well, but that's the approach. And once you have that clarity, it makes it a lot easier to make decisions, because a lot of clients that we've spoken to are saying, well, I've got JobKeeper, I can keep my staff. And then we ask the question, well, once JobKeeper falls away, what are you going to do? And that's where people are now turning their mind to. And that's the government withdrawal symptoms. I think that's going to be a major issue in September, October. We'd suggest, getting your plan, getting it together now, and developing it through June, and then you'll have at least a ability to be able to move forward. And that's what we're doing as our firm as well. I mean, we're looking at it. There's an inherent uncertainty about what this is going to look like going forward, but how we move forward, we're just going to have to ride it and ride the wave. And the other issues which Nick will talk to a little bit more is there's a lot of legal issues and responsibility that everybody's going to have as a business owner and whatever else. And Safe Work don't have the resources to be able to supervise or implement what they have, but they have activated a lot of resources, and there's so many publications in there to try and understand it. It's not prescribed at the moment, in my view. All it is giving you ideas around what you need to be and what you need to be doing. How you actually implement that in a best practice sort of approach, well, that's what everybody needs to be mindful of. So that's going to impact your workers' comp structure, and it's also going to impact potential liability issues. And then there's also this other interaction issue with your staff, where their expectations need to be built into it as well, because there will be some people who will say, I am not willing to come back to the office. I've had another conversation today about a woman returning from pregnancy leave. So she's been off on her leave, and she's returned, and she wants to resume as a full-timer, but there is no job for a full-time job, because no role for a full-time job, because the business has obviously changed, and that's leading to a redundancy, it looks like, in this sort of scenario. So all of those things are going to roll out, and each of the approach of the employees are going to be going to require more time, and business owners, unfortunately, are going to be more and more taxed around these issues in terms of not having the capacity to work on their business and deal with all these things at the same time. It's just going to continue to ramp up and create more havoc for them. That's why, if they've got a little bit of time now, get the plan together, work with you guys as the accountants, and try and get them an understanding of what levers they can pull, so that when things start to really ramp up and these things jump out at them, they've at least got an approach and an understanding, and the rest of the business is stabilised. So I think that's me done, Tony.
Tony, you're on mute, I think, but as long as you can hear me, Todd.
Yeah, got it.
Yeah, I can hear you.
Over to Nick. Thanks, Nick.
Tony being on mute's often good.
Yeah. I'm off mute now.
No, it's going to be hard going back to the real world where I don't have a mute button that I can press on people. Thanks, Todd. Yeah, looking forward to seeing you from 1.5 meters away in person shortly. My presentation today will be different to the subject matter that I've been covering to date, which has really been about standing down staff, alternatives to stand down. Then we had JobKeeper, what that meant, both in terms of payment rules as well as these new wider stand down powers, temporary powers given to employers. Now we're looking at the next phase, which is a return to work. Todd mentioned Safe Work Australia. The reality is that employers have always had work health and safety duties that are built into statute, extremely important, essentially compelling employers to guarantee a safe workplace. Now, that is a very different looking obligation now that we've got COVID-19. Safe Work is trying to assist employers to facilitate employees coming back to work, but against the background of these very serious statutory obligations, that's difficult. And Safe Work are trying to provide guidance, but at the moment, I think there's about 1,300 to 1,500 pages of guidance on the Safe Work website. So it's pretty difficult to distill. I might just start though with some recent stats and also some pretty significant cases that aren't really COVID related, but have pretty significant wide-reaching implications. So just to start with some stats, there was a presentation by one of the Fair Work Commission members at the start of May, and it's just interesting the level of activity. So there's been a real surge in unfair dismissal claims since COVID-19 hit, about a 60% increase, which is extremely significant. And the reality is the Commission just does not have the resources to deal with them quickly. Stand down disputes have increased 5-fold. There's over 200 cases lodged. What's readily apparent is that of these cases lodged, only about 25% of them actually fell within the jurisdiction of the Commission. So when these JobKeeper rules came in, the Commission also created a new JobKeeper stand down dispute resolution area of the Commission. So if someone's been stood down, either wholly or partly, or been requested to take annual leave, or requested to change their days of work, or requested to do different duties, an employee can apply to the Fair Work Commission to have that matter determined. Clearly, most of the disputes that have been lodged have fallen outside of that jurisdiction, which means the Commission just can't deal with them. And the majority of the cases that the Commission are dealing with are about employees that have missed out on JobKeeper and think that they should have been nominated. So it's really about eligibility. And the Commission have clearly stated that they cannot determine JobKeeper eligibility, which begs the question, where do these employees go? I had a client ask me that question yesterday, and I was thinking about it already with some of these decisions. And the Commission has actually said it's just not clear. There doesn't appear to be a dispute resolution mechanism for employees that have missed out that want to query or challenge their eligibility. The ATO, it doesn't look like they can necessarily deal with it. The ATO can deal with employers' issues around nomination of employees, but not really a resolution, dispute resolution provision for employees. So I think there might be some movement there, because clearly there's a lot of employees that are thinking that they should be eligible, probably casual employees, and have missed out. Another significant decision was Qantas has been in the news a bit, but they've also been in the news with respect to these stand down provisions. So as most would know, they stood down a lot of staff when COVID hit, pre-JobKeeper. What the unions tried to argue was that the employees that were stood down could still or should still be able to access their sick leave if, for example, they had operations booked or were actually unwell, which meant even though Qantas didn't have to pay them when they were stood down, if they were genuinely sick, they should be paid for that sick leave period. Well, the Commission has held that that's not correct. Sick leave is an alternative to working, and when there's no work to do, there's no sick leave payable. So that was knocked on the head, but things like jury duty, community service leave, public holidays, they are all protected. So if those things are falling during a stand down period, you do need to pay employees for those separate leave entitlements. The massive one that landed yesterday was this federal court decision in relation to WorkPac and Resato. So this is another decision following an earlier decision called Skeen, which is also against WorkPac, where you had a casual employee, a person who was engaged as a casual, that was claiming, notwithstanding that they were receiving a casual loading, which is really meant to compensate someone for the full-time permanent entitlements that they don't receive, things like sick leave, annual leave, long service leave, notice of termination, redundancy. So this person was actually claiming annual leave, notwithstanding that they were a casual. Surprisingly, they were successful. And I think it has enormous implications. There's already multiple class actions being run by casual workers in the mining industry to try and claim these leave entitlements. So, what the court looked at was whether or not there was some firm advance commitment to future tenure. So this was someone that worked for the employer for about 6 years. There was a series of rolling contracts. There was no doubt that this person was paid a casual loading. The court held, we don't care what the contract says. We look at the actual substance and form of the relationship. If there's stable, regular, predictable employment, that's a deciding factor. So, I've already expressed concerns with respect to employers that are simply nominating any casual on their books that's been with them 12 months into JobKeeper, because part of that nomination also deems them to be regular and systematic, which I think means there's an argument that these people then can claim permanent type entitlements in the future. And now with this case, there's no doubt that risk is even heightened. And what the court also did is they said, you can't offset that casual loading that you've paid to these people against this annual leave entitlement, which basically means that there's been double dipping. The government even tried to legislate around this after the first decision, the Skeen decision, and the court held that legislation didn't help. So what I expect is the government will try and legislate to basically fill this gap. But my view remains, if you've got a casual that's been with you for at least 6 months, 12 months, and they're fairly regular, fairly systematic, have some firm commitment or predictability, there's a really good chance that at some stage they could argue that they are a permanent employee and succeed. So just moving into the last part of what I want to talk about, which is what the government's calling a COVID-safe workplace. So in late April, the government released these national COVID-safe workplace principles. Safe Work Australia has now developed this resource kit. As I said, it's 1,300 pages of information and applies to 23 industry sectors. It's covering things like work health and safety obligations, workers' rights, consultation, risk assessments, emergency planning, hygiene, cleaning, personal protective equipment, mental health, family and domestic violence, working from home. But what the government, notwithstanding that they're telling people to get out from under the doona and go back to work, what's I guess missing from that message is that employers have these statutory health and safety duties. So they absolutely need to be taking active steps to prepare for an actual return to work, whatever that looks like. So we've been helping clients, develop basic policies and guidelines, trying to distill all of this safe work material so that they're looking at, what their workplace looks like, what considerations they need to take into account, and what steps they need to take, some suggested action. So just to go through some of these areas that might just get you thinking about your business or your client's business. So firstly, preparing for the transition back to work. So how will you re-engage staff? Who's going to be selected to return to work? how you deal with those employees who might be reluctant to come back to work. As Todd mentioned, you might have people that have concerns about getting back on public transport, or those people that might be considered to be vulnerable employees with, compromised immune systems. So relevant, action plans there would be state and territory health directives. So, in New South Wales at the moment, there is a public order which essentially mandates that if it's reasonably practicable for an employee to continue to work from home, then they must be permitted to do that. So really you need to be looking at, where your business is located and what existing health directives apply. Secondly, looking at risk assessments, absolutely need to be doing one of those. There's a lot of guidance on the Safe Work Australia website about what a risk assessment looks like, but you need to be looking at, obviously, the risk of contracting COVID-19 in your workplace, traveling to and from work, potential exposure to non or from non-co-workers, so clients, suppliers, members of the public. There's a massive emphasis on mental health risks. So that could be anything from, employee concerns about contracting COVID-19, or it could be related to prolonged working from home, social isolation, or, economic consequences of the pandemic. Health and hygiene is obviously a very significant area. Definitely going to need something that looks like a health and hygiene policy. If you are in an industry that requires personal protective equipment, masks, looking at that. Cleaning practices completely need to be reworked. Again, Safe Work has good guidance on this stuff, but looking at things like in a normal office environment, touch point cleaning, which they're referring to it as. So, door handles, kitchen taps, printers, fridges, other shared areas, as well as sanitation products, and investment in sanitation products, alcohol wipes, hand sanitizer for use by employees. Next big area, physical distancing. So that can be anything from reconfiguring the physical workspace. Obviously, we talked about hot desking being probably a thing of the past for now anyway, as well as looking at a plan for employees to come back to work. So that might be rostering, staggered start and finish times, and also just managing the number of employees in the workplace. You've got to look at this 4 square metre rule as well as the 1.5 rule, and both of them are applicable. So can you have all of your staff back in your office space at once? I know with our business, we just could not accommodate having all our staff back in our office at once. We would breach those rules. So you've got to look at groups of employees and how that operates. Moving on to another huge one is working from home. So clearly a lot of businesses have requested or required their employees to work from home while the pandemic's been in full force. But when we look at this phasing back into work, some employees clearly will continue to work from home. There have always been obligations to ensure that a home office is safe, because the workplace is wherever people do work. So that is at home. So if someone's injured at home, it's a workers' compensation injury potentially. So now that working from home will be part of our future, businesses need to be looking at, working from home policies, working from home safety checklists, as well as, establishing frameworks for, communication with employees that are working from home, ensuring that equipment is safe, encouraging people to move throughout the day, ergonomics, all of that sort of stuff. Communication with employees is a big one. Safe Work is strongly recommending. So that can be anything from, conducting surveys with employees about their expectations going back into the office. What are they worried about? How can they facilitate doing their job going forward in the new office environment? A lot of my clients are looking at EAPs, like an employee assistance program, which is an external program. If people have issues that they don't want to necessarily tell their boss about, it might be a mental, physical, or otherwise. It's completely confidential. It means that you don't hear about things you don't necessarily want to know as a boss, but there is at least an avenue for employees to raise issues. The final one is this COVID-19 response plan. So you're going to need to have a plan that your employees know and understand, which applies to contracting. What happens if someone contracts COVID-19 in the workplace, one of your colleagues? It's going to cover things like quarantining, self-isolation, notification to safe work, cleaning, disinfecting. The other important, I guess, corollary of all of that is sick leave. So I think the whole concept of people coming into the office when they're showing, cough, flu, cold symptoms, it will be a thing of the past. So if you've got a sick leave policy, it will need to be looked at again. I know certainly with our staff, we've made it very clear that they're just not to come in the office if they're showing any symptoms. And we were looking at this as COVID was just starting months ago, but it really just needs an entire rework. There's a lot of content. I'm saying to my clients, just make sure you have something in place. Clearly the focus at the moment is getting back to business. My clients just want to focus on getting back to business and becoming profitable again, but don't ignore these COVID safe workplace requirements, because safe work, we don't know yet to what extent safe work will look to enforce where there are breaches, but they absolutely can on the legislation as it's currently drafted. So you need to turn your mind to some of these things, even if it's implementing some basic policies and getting them out to staff, or an FAQ or a checklist. You can't sit on your hands and not do anything, because I think it will just count against you.
Nick, are we going to have a COVID drill like a fire drill?
Look, I wouldn't rule it out. At the moment, because every industry is different, Safe Work have got these industry specific recommendations, but I think if you fast forward 6 months time, there's probably going to be a Safe Work designated COVID-19 fire drill that everyone's required by legislation to comply with. But in the interim, you've got to come up with your own.
Because we're already looking at having wipes near doors, access doors and whatever else. So every time you go through a door, you wipe it down and all of those sort of things. Because the only thing that I've seen that's similar to it is and requires an automatic sort of lockout is asbestos. And I've been in a couple of places where asbestos has been found, particularly fibrous, and you just exit, you're out. Like you just literally just walk out.
And Safe Work has a regulatory guide on asbestos in the workplace and what you need to do, and that's legislative. So if you don't do it and there's an incident, you can be prosecuted and you're assessed against their guideline. So that will be the future. Now, I think obviously Safe Work's nervous about prosecuting a small employer that happens to have an employee who contracts the virus. But if you look at your Newmark house, your nursing home, where there's clearly allegations of negligence and allowing an employee to come back to work for 8 or 9 shifts, they're probably going to be the scapegoat for what happens if you get it wrong.
And realistically, that is going to be a push and pull issue in October when JobKeeper falls away and people need to work to get paid, and there's going to be that sort of tension that is not there at the moment because JobKeeper's given a safety net, but that's probably going to be an issue once everybody gets back to normal. Correct.
And look, there's all these claims being lodged at the moment in the Commission, and they're not being determined yet because they don't have the resources to, but you'll see these start to come out about people that have been terminated because, they exercise or they made a complaint about their fear for their own health and safety, going back to work. There's going to be all these guidance that's going to come out in the next few months that I guess will make a little bit more clear what employers need to do.
No, I can tell you for a fact that the REITs and the office building owners are already all over this stuff. It's already in terms of negotiating, new tenancy agreements and stuff like that. They're building all of this stuff into that. And it wouldn't surprise me if, temperature testing machines are installed at the entry to all building offices, if not most, pretty quickly.
They're looking at what Taiwan's done, right? And they're looking at how they've gone about that. So every building you go into, you get tested, and every time you get on public transport, you get tested. And that's how Taiwan's managed it. And that's why they've had such low community distribution, I understand. So
things like wearing masks, in a lot of Asian countries, that's just been the norm for a long time. And I think that's what we'll see in the West going forward. If you've got cold and flu symptoms and you're on a train, you put your mask on, and it won't be usual, I don't think, in the future.
Yeah. Well, there's no immunity in the community. So until we get a vaccine, this is just a fact of life. You know, I think it's not something that's just going to necessarily disappear over time. It may not disappear till we're all vaccinated for COVID.
So Tony, it's like death and taxes, and that's a good conduit for Pete.
Yep. All right. Pete, over to you, young man. Now, you're going to give us a brief update on JobKeeper, and then you're going to run through some tips that that our community members need to bear in mind as we head towards the end of the year. Over to you, Pete.
Right. Okay. Thanks, Tony. Just waiting for my slide to come up. Yep. So, all right. So, as Todd and Nick have been saying, things are obviously changing. So, our presentations are quite different to what they have been the last couple of times. So, there's really just one slide here for JobKeeper. So, it's now live. We moved into the system. We've been through all the changes that were constantly happening. So firstly, what are we? You all looked at a lot of the detail. So where are we up to in terms of May? So what are we doing? We've still got till 31 May to finalise turnover testing. I know we're still in our firm. A lot of our clients have registered already and have started to receive the payments, but we've still got clients that are making use of that extended deadline, which was handy where it wasn't quite so clear cut or people weren't quite as organised. So there's still time to, even back to the beginning of April, to work out, do they satisfy the turnover test in one way or another and get those registrations in. So 31st of May, still that deadline. And we are, as I said, we are seeing payments for the people who've actually got the forms in. We're starting to see, and you're probably starting to see those payments coming through. So then really the system is starting to kick in. And I guess all those employers who had to fund all the payments to staff, particularly the top-up payments, are now at least starting to get the benefit and perhaps the cash flow, even though there's still that payment in reimbursement in arrears issue, which I suppose Todd will start to see. You'll start to see that as an ongoing issue from a cash flow perspective. But you know, perhaps it's at least catching up a little bit, and to some extent. So. Okay, the other actions, getting into the monthly JobKeeper reports. And interestingly, I just saw actually hot off the press, Accountants Daily. Some of you might get their updates. Something came through there about the an ATO, or you might have seen the ATO announcement. So there's the rules basically said 7 days after the end of each month was to lodge the monthly JobKeeper reports for the previous month. So that was that's now been extended by another 7 days. So starting from June. So which is good, I suppose, gives them more time to report. But of course, the longer it takes you to report, the longer it'll take to actually get the reimbursements. So those businesses that are organised will want to get the reports in as early as possible after the end of the month anyway, in order to get the money as quickly as possible from the ATO. But from a compliance perspective, there is now a bit more time. I'm still not sure if we've got a clear understanding as to what supposed to happen for April. It's a bit of an odd one because theoretically the April monthly payments were supposed to be monthly reports were supposed to be lodged by the 7th of May, and yet you had until 31st of May to register. So that I haven't seen that deadline being enforced, and that just doesn't make sense. So I've been applying. There's a question here. I'll get to that in a second. So the way I've looked at that is that if you've got till 31 May to register, then surely the ATO can't expect necessarily for the April reports to be lodged until the end of the month, and there won't really be any consequences of being a bit later with those reports. And really the consequence for the business is that if you don't lodge the report, you don't get your money. So but certainly from the May onwards, so for the May periods onwards, then you would think that for the month of May the report should be lodged by the 7th of June, and then, as I said, going forward, that's been extended to the 14th of the month. We've talked, of course, before about top-up payments. So naturally, too late if you haven't made those payments. But for the April, for anything, those fortnights in April, 8th of May was the deadline to make the top-up payments. And then we're going forward, we're into that system where $1,500 per fortnight is essentially the requirement. So if that needs to be topped up because people are earning less than that, then that should really, I would have thought in a practical sense, that should be happening as part of the normal payroll cycle. So certainly we've had a number of questions to the ATO about how that works practically, and it seems to be maybe made pretty clear that if employers are paying monthly, as a lot of businesses do, then it's perfectly, the ATO has the power to allocate payments to employees between periods, so that it's perfectly acceptable to pay $3,000 a month. Although I suppose the trap there is it's got to be 3,000. It's got to be still 1,500 per quarter. So I think we've worked out that in August there would be 3 JobKeeper fortnights. So potentially there have to be more paid in August, or somehow, whichever way it's worked out, that they have to receive the equivalent of $1,500 per fortnight, not just 3,000 a month. So it's just a matter of and we've had some clients where they're looking at quarterly periods, and so quarterly, how does that work? That's probably but I think the monthly would be, I would think, be by far the most common one, and possibly even fortnightly or weekly. Just a couple of more points there. So if you're not aware, the JobKeeper reports going forward, so those regular, so the main things you're reporting on, if you haven't seen the forms, it's the employee numbers. So that's what will change. Obviously, if people go off the payroll, then you can't claim for them anymore. So while you'll stay in the system, if the employee numbers fluctuate, then you'll have to actually report on that, and that will influence how much the business actually receives as a reimbursement under JobKeeper. And then you've got you're reporting current and projected turnover. Not so much, the ATO says it's more of a record keeping sort of statistical sort of information gathering exercise. You'd have to think it'll be used as a bit of a tool for enforcement as well. So if they start to see numbers, again, as I think we've touched on before, you're not specifically required to measure your projected turnover calculations that you've used for eligibility and registration against the actual results in future periods, say for the June quarter. If the projections were reasonable, the ATO should still accept them even if they're a bit out. But in a practical sense, if the reported numbers show that they're way out, you'd have to think that's going to give a higher risk of ATO activity. So then we get to that final point of record keeping. As with a lot of things in tax, record keeping is key, because a lot of this is self-assessment. So the ATO is saying it will come. They've obviously been in the mode of providing guidance, coming up with various things, processing registrations. Now they're starting to issue reimbursement payments. So they've been through all of that and probably been fairly concessional.
And Pete, the other thing at a practical level is that also impacts your ability to be able to access the code under the SME landlord structure. So people who haven't been able to substantiate their position are struggling to be able to get the deal done with their landlord.
Right. Yes. So you've got to be complying. Yeah. So there was that. So that's exactly right. So there's a whole lot of flow and effects from this stuff, and but certainly enforcement will, and considering the anti-avoidance rules that are in some of the eligibility guidance as well, is that again they've been fairly lenient and understanding, but if the ATO sees that figures have been manipulated or sees things they're not happy with, they will come down, and again maybe that'll flow into some of the things you see, Nick, is that there'll be enforcement.
I was going to say the other area where you want to make sure you set out at least your assumptions and decision-making rationale is if you've got casual employees that have been with you for 12 months, but you don't think that they are regular and systematic. And I had this client yesterday where they've actually turned their mind to each casual that has wanted to be included. They formed the view some of them are not regular and systematic and excluded them. Like they had one person that went to Italy for 3 months And they're blowing up that they haven't been nominated, but they've actually got criteria for who is a regular and who is a systematic casual employee. And those assumptions are kept somewhere. And if ATO or the commission comes knocking, they'll have some assumptions that they can, and some documentation that they can provide.
Yeah, well, that's a good point. And I think that point you made earlier, Nick, about the risk, and I've heard this even before all of this, before this whole JobKeeper and before COVID-19, you know, we've heard the point you made about casuals, and at what point does a casual potentially become a part-timer? And so, I mean, that has been I think we've been aware, you know, that has been a risk that employers do face. So, so if they have, picking up on your point there, if they have policies that sort of tried to guard against that risk, then presumably that flows into this.
Well, look, if you've nominated any casual employee as part of your JobKeeper eligible staff, you've basically deemed them to be someone that's been with you 12 months and a regular and systematic casual, which means if they're award covered, they automatically have an entitlement to request to be converted to part-time or full-time. Doesn't mean you have to agree to it, but you can only request it on reasonable business grounds. So I think a lot of this, a lot of employers will be facing applications from casual staff to be converted to permanent.
So conversely, if people have been smart about it and have guarded against it and excluded them, like you say, then yeah, they may well be right, but the employees may not agree. Yeah, so it's certainly an interesting area. So I might just, before I move on to the next slide, I might just address a couple of queries that that Paul has raised. So not so much about JobKeeper, more your first one, I think, Paul, is about the cash flow boost. So I'll just read your question here.
Pete, do you want me to read it out for everybody else so they can?
Yeah. Sorry, do that, and I'll
Yeah, well, you're doing it.
Gives me some thinking time.
Yep. So the question, or the statement and query is that ATO may be playing judge and jury with the $10,000 stimulus for some clients who are registered for PAYGW during Q3. One client has a $26,000 super guaranteed debt with the ATO, and to date they've denied the 10 grand March rebate. Is there any suggestion, or how do we suggest that that you deal with legitimate claims being roadblocked by the ATO staff? Because I understood that was one of the specific issues that was raised, Peter, that it would not be applied to any payment arrangements or any other issues.
Well, that's a good, yeah. So that's a good point, Paul. So look, so do I take it? Maybe you can provide a comment there, Paul. That do I take it the credit has not been raised at all? So, or is it that it's been applied against the debt? Maybe you can just provide a comment to that.
I think it's I think it's that, because then the second issue that he's raised is that they suspected the client wasn't.
Yeah. Okay, right. So you've explained that a bit further, Paul. So, and that's an interesting point, and I think, look, it's obviously you have to address the specific concerns and try and convince them of that, and okay, take your point, Paul. And Paul suggested they're suggesting it's artificial, and you say it's not. Sometimes with the ATO, it's you get one person, you ring up again, you talk to someone else, you get a different answer. So that's always a trick when you get someone that just isn't giving you a sensible answer. I can only suggest if you're not getting, if you clearly believe they're wrong, then this is probably like anything. You've got to try and go through the ATO, try and get it escalated to someone who'll give you a more sensible answer, and make it a complaint. If it's something that you're really not getting joy with, make it a complaint. Possibly even I find often when we raise queries that are like this, that they take it through the complex issues resolution area, and that will tend to get it to somebody who actually is a bit higher up, maybe a bit more technical, and will in the right area, and then we'll look at the issue and address it properly. So, perhaps something like that. You try it as a complaint, perhaps lodge it through the portal as a complex issues resolution query, and if that can get allocated to someone in a reasonable time frame, then you might get a more sensible answer. That's probably the main thing I could suggest, Paul.
Well, I've had that as well with a couple of clients where we've wound up in it, is where they said they decided they wouldn't give a GST refund or an R&D refund on the basis they didn't think it was a legit business, where they just don't like it. They take a set against it because they don't like it.
Yeah.
And we had to threaten to take them to court just to get the GST back out of them. And they said, well, it's not a legit business. We said, well, you've accepted the PAYGW. So how is it not a legit business? Because under the definition, as soon as you start paying PAYG, you are operating a business, because it's very low threshold to be able to say you're operating a business. But Peter's right. Sometimes you get these guys in there who just take a set against you and you can't move them. It's very difficult.
So that's all I can, Paul, suggest, Paul, just go through those channels. So I'll just scroll down. Yep. So give it a go. Look, obviously you and I deal a fair bit, Paul. So if you're not getting any joy, come back to me directly and see if we can help you. So all right. So maybe we'll just move on to the next slide. There. Okay. So what we're going to address here is beyond JobKeeper for this year. What are some of the key points? I mean, tax planning will often be. It's often going to be a lot of the same things as previous years. So thinking about a couple of specific areas, Div 7A, we've just been turning our mind recently to what's different this year. You'll be aware that the professional bodies have been pushing for lodgement extensions, are still pushing harder. So far, 5th of June is as far as we seem to have got. I know we've been getting we've been lodging a couple of specific extension requests for our clients. We just got one this week that was till end of July, which we had granted. So you're hopefully getting some joy with specific client extension requests. But this was certainly the ATO has made very clear that in relation to the general blanket extension till 5th of June, even though the company returns would normally be 15 May, that will also have the effect for this year of giving you until 5th of June to make the loan repayment, make the full repayment of the loan, or put the Div 7A loan agreement in place. So that's just not much difference, but it's something if you're still finalising the work, but it's just make sure. I suppose part of the lesson is just make sure you address the Div 7A loan from last year in whatever way you can. If you think about some of the other ways, obviously dividends is often an area that's used. So query for this year is, are there enough profits and franking credits from, say, paying instalments to cover, to make those frank dividends, which you would normally use to repay the Div 7A loan agreement, particularly if you've, say, varied the company's March instalment, for example. That would, by paying less instalment tax, PAYG instalments, you're also reducing the franking credits that are available to pay frank dividends in this financial year. So those are the sort of things that might cause you issues. Just have to think that through before you even get into cash flow. Some of this is just what do you do in the books. But certainly profits, what's coming in, how's that changing the ability to pay dividends. Then when you think about borrowings, okay, you can the whole idea of a Div 7A loan or putting a loan agreement in place, especially if the interest is non-deductible, there's a short-term benefit from fix there, but what is what happens? And this is where it probably cuts into a lot of what Todd looks at from a cash flow business perspective. What's the medium longer term issue in the client if you're having to borrow, if there's cash flow issues, or if you're taking money, if companies come out of companies and you're having trouble repaying it, there's going to be issues in the business one way or the other. So anything you want to add to it there?
I see this is, I think this is like, this could be one of the steps that everybody starts to become to the reality that the things have changed and that everything needs to be reset and adjusted. And this is one of those sort of issues I can see coming up as they go to do their tax return and go, okay, here's something, I've got to borrow money to wash this out. Yeah. Then how do I get it back? And all of those sort of things. There's lots of little things that are going to build up in the next 2 to 3 months. Yeah.
And you can sort of kick the can down the road a bit, but Division 7A really is a rabbit hole that you can fall down and it once it starts building up, it becomes a real problem to deal with.
And that's where, like, it could end up with a real problem. You either end up with extra debt that you don't really want against you personally, or you end up with a Div A personal issue, and like you're damned if you do and you're damned if you don't have a plan.
Absolutely, yeah. And if it creates significant personal tax liabilities, that could be, again, you can get in a position where in a particular year the tax liabilities for the company become quite high, for the individual become quite high. So it's just, yeah. And if trusts, then you get into trusts and unpaid present entitlements, and then it gets really messy. So you just got to be just so careful about all that. Just moving on to just invest from a personal structure perspective, perhaps for the business, for your clients with investment structures, or for the business owners, and they're thinking about either personally or through companies and trusts as investment vehicles. You got capital losses. There's obviously a lot of capital losses out there. Realizing them, advisors will tell you this is not the time to sell. But if you have been realizing losses, or if for however it arises, just thinking a bit of planning about how, if you've got larger capital gains that might have come through the early in the year, perhaps realizing some capital losses isn't such a bad thing if it manages the tax position. But all obviously depending on the investment situation, like what's the best thing to do. Should you sell out from an investment perspective? But if there's going to be losses realized anyway, when's the best time to realize them, and when's the best time to use them? And if you're stuck with losses, how can you use them? Don't get losses stuck in a company or a trust that you can't utilize. Those sorts of, all that sort of planning, which don't have a loss this year, say a profit this year, and then a loss next year. That's sort of those sorts of disastrous outcomes that perhaps could be avoided with the right planning. Okay, incomes, obviously if incomes are down on investments, income splitting might be less useful. Negative gearing, we're in a very low interest rate environment, so probably less benefit from negative gearing. But just again, I think year-end tax planning for this year is going to be an interesting one, and so there's just probably some extra things to think about. All the usual stuff that you would look at, but trust distributions, where should the trust income go if you've got things going through a family trust? As I mentioned, perhaps using corporate beneficiaries, but being really careful about that, because it does get really messy. And is it even worth it in some cases? Then you get on to property investments, obviously with vacancies and having to grant rent relief. I think it was a story I read the other day where sort of somebody, even an individual who had an investment property and was renting herself, was in a position where she'd given relief to one of her tenants who'd lost their job, but then her landlord wasn't willing to even talk about doing anything with her rent. So, there's an awful lot of people out there with difficulties, and if you're certainly if the rental income is down, then or if you've got vacancies in properties, then it makes things certainly a bit tricky. So again, there's going to be probably things that your clients are going to need to talk about in relation to those sorts of things. Like one of my clients, I think, has got a lot of residential properties. His wife's got one commercial property, and there's a gym in there. So obviously the rent there's been no rent coming in for a period of time. So they're the sort of things you'll see. Okay, so moving on to personal tax planning. Some of the basics. If you think there's a refund due, particularly if income's been down this year, lodge. We're going to come up to tax time pretty soon. Then look to lodge the 2020 tax returns quite early if you can. Home office expenses. You would have all read there's the general rules on home office expenses, and then there's the additional concessional rule that the ATO's that's been put out. So they try to make it as easy for people to claim home office expenses when a lot of people have been working from home for a period of time. So look at that. Look at the the existing methods, which are more time consuming and but might give you a better result, or you might just go for the easy method, which is at least gives people some sort of a claim. They're obviously going to have some days working from home, so so look at that sort of thing. Then that's the usual thing, bringing forward deductions. I mean, who knows what your 2021 income is going to look like? That would be the key. That would be one going. But if there is an expectation, sometimes bring forward deductions is good from a tax timing perspective. But if there's an expectation of look at when income, maybe you want to have deductions because that won't be as valuable next year. So that sort of thing. They're all the points I really want to cover, Tony, because there's really not as much to talk about this time. But turn it back to you at this stage.
All right. Look, thanks, Peter. Look, I think we'll wrap that up. We've hit the 1 o'clock mark. Thanks very much to Todd, Nick, and Peter for their updates, and thank you for joining us today. You might like to just complete this little poll that's come up on your screens. Feel free to reach out to us anytime. Doesn't have to wait for the fortnightly briefing sessions. And we would invite all the community members, if there are things that you would like us to cover specifically that we haven't covered, feel free to let me know, or Todd or Peter. We're only too happy to do that, aren't we, Todd?
Yeah, and there will be that presentation on private equity with probably with Jeremy Samuel from Anacacia, who specialises in SME. So that will be something to look forward to the next week. And if you have any queries or issues or whatever else you'd like to know about private equity, the mysteries of it, happy to take those if you want to email them through to Tony or I, and we'll bring them up and take that through the conversation that we're going to have probably next Wednesday. Thanks, Todd. Yeah, and we're looking to do a few different things when it comes to these webinars. I think the stuff that Nick talked about today, that's going to be an evolving matter of interest, because there's going to be lots and lots of workplace changes and responsibilities, and so we'll keep updating on that. But we're also looking to bring, like Todd said, someone in from private equity, and we're looking to do a few other things which I won't talk about now because it hasn't been set in stone, but it'll just be a little bit different and might be of interest to everybody. So once again, thanks for joining us. We'll keep in touch, and we look forward to you joining us in 2 weeks' time, same time, Friday. Thanks very much.